Lincoln. You know, he's supposed to be honest Abe. Can't lie, right? So his wife asked him if she's big. I know this man just made big fat. And he's like, he's fighting with himself. He can't answer. Because he doesn't want to say, you're fat, but you can't lie. And all of a sudden, honest Abe, man, it's hard not to lie. We're gonna beat the market today. We're gonna conquer the market once and for all.
Do you ever trade after hours or no?
It's not, I don't like it because there's not enough liquidity. I just trade during the market. After hours, if you want to buy, it's good to buy, I think, in a general sense, because you can get a cheaper price. But selling, I don't think is that good because prices aren't gonna. There's a wide bid ask. Makes sense?
Yeah. Can you talk to a little bit about the volume? Like what's
okay.
happening out there? Like, so.
Are we going? We're gonna conquer the market today. I said that. All right, volume.
You can turn the light on back there so you can see better.
This one?
Yeah.
Okay. Do we have an eraser?
Yeah.
Can you see this on the camera? Is it coming through? Maybe get closer.
The eraser could be, so I'll find it. If not, we can just use a rag.
Go to my phone.
Yeah.
I like doing like 2 million shares a day. Volume. If not 2 million shares, 800,000 a day. Minimum. So you want to try Amazon? Go with the boss.
Yeah.
Amazon is 8 million, no, it's 5 million a day.
5 million.
So it says 5.4 million average volume. And then Friday it was 8 million. Friday. Which means the volume is up. Almost double. That's heavy volume. But the whole market was heavy. But also Amazon was heavy.
But is it always heavy on the way down or can it be heavy on the way up?
Both. So, this is average volume, right? 5.4 million is at Amazon, right? So 8 million was on Friday, so it's more, it's heavy. Okay, so in a general sense, if the stock is up and the volume is up, that's a bull. That's a star, that's a bull. That's good. If the stock is down, you get this,
Yeah.
and the volume is down, well, actually, this is preferred because when the stock comes down, the volume's down, it's not concise. So it's still, okay, so this is,
Like flat.
this is like say flat. Now when the stock is down and the volume is up, that's a bear. That's bad. Okay? Because the worst thing is to have volume up and the stock down. Because it's heavy selling. Heavy buying, heavy selling. This is more flat, and then if the stock is up and the volume is down, this is not concise. There's small buyers. So it's really you can say it's really flat. So what's going to happen is this is going to come down much more than this. This is going up with a passion. There's buyers. Everyone's coming in. It's going up. it'll go up higher. This one with the low volume, you have to look at the volume, so you're going by the average, right? So low volume will be like 3 million, 3.2 million, low volume, okay? And then it's not so concise, so any up move like that could come right back down. Now, when it's coming down in this low volume, it's not really concise either, so it'd be easy for it to come up. This is a buy point, this is a buy factor based on this. Okay, this is a sell. When it's down volume and when it's down market and high volume, that's a sell sign. So here you have a buy, here you have a sell, and these ones are just going to be depending on what happens next. So low volume is kind of a wash.
Okay.
Now, can I erase this? Are you right here in the middle? Can I draw on this or this? What you also want to look at, I call this island trading, is when you actually know the buys and the sells. Sells and the buys. What happens is you have like 200 here, like the price of Amazon is $14.95. So let's say I have $14.95, $1,500, $14.90, $14.50, and here you have $15.10. What happens actually in the market is you'll actually have orders that are in place, and this is where you can actually see the buy and sell orders. That's called algo trading. Okay, and so if there's someone wants to sell 200 shares at $14.95, and let's say there's a thousand. If it's here, there's 1,000 on $14.90, and then here at 15 they want to buy 1,000, and then down here at $14.50 they want to buy 2,000. Okay, and here at $15.10 they want to sell 2,000. What that's saying is you have orders that are in place. There could be computer trades, there could be a guy that's put the limit order, there could be the floor brokers trading his own account saying I'm going to have an order to sell if it hits $15.10. I have an order to buy if it hits $14.50. So what they're doing is well, the buys are on this side. So give me some buy orders, Chris, give me some numbers here. It could be more or less than these. Just give me some
300.
300 on the buy. Up here. One more.
500?
500. Okay, now here, $14.95.
200.
200 is pretty light. A little higher. 1,500, 1,000. So now what's happening is we have a big sell orders, 2,000, 1,000, 1,000, but the buy orders are pretty skimpy. What that's saying is that people are ready to sell. They're more worried. And the buy orders aren't really coming in. And hopefully there's a 2,000 or 3,000 up here. Somebody wants to buy it. If it hits this point, it'll go higher. That's the feeling. There's a philosophy that says wait until something goes up and buy it, then it'll keep going up. In this case, they want to buy 2,000 shares at $15.10. But still, if you add up all the sells and buys, it's the sellers. They're more sells, so this is going to cause the stock price to go down because there's more sells orders than buy orders, and that will indirectly affect this, and this, and where the stock's going to go. So you can actually look at the actual buys and sells. They have it. You have to ask for it. They have it with TD Ameritrade, and then you can actually see what orders are buying and selling. The thing is with this, it moves so fast that you'll see these blinking and out like seconds. They're just blinking, 2,000, 4,000, 2,000. So you can look at the buys and sells and get a general sense of what's happening. It's a buyers today. They're selling today. So the market's going up and Amazon's going up, and these are looking good. There's going to be more buys. And the sells are going to drop down to 100, 200. No one wants to sell, which makes the stock go up. That's how happened with Netflix. Went from 200 to 300, easy. A lot of buyers. The sales dropped off to 200, versus 1,000 buy order, 1,000 versus 3,000. Now makes the stock go up. There's more people that just want to buy it, and you can actually look at that. But it might change from morning to noon. It might change from day to day. So that's the next step you will look at. You have to do it to know how to do it. But so back on the basic way, ideally you want to look at the volume, the average volume, which is the last 10 days. And in Amazon's case is 5.4, and heavy volume would be 8 million, and light volume would be 3 million. And then you'll know on light volume, you know, if it's going up, that's okay, but the product will come back down. It's not concise. On a down day, on a heavy volume, it'll keep going down because. So we'll see Monday. We'll see if it bounces back up on Monday. So what you're looking for is up volume on an up day, and that's a buy signal. Down volume on a down up volume on a down day is a sell signal, and then in between is just depending on what's going to happen next. Ideally, you want to buy when the stock is down on low volume because it can come up easy, and then when the stock is up on a low volume, there's no conviction, so it's going to come back down. You understand that?
Yeah.
So look at the average volume and look at what you're at, and then by the end of the day, you can gauge it. Sometimes in the morning, they already hit the average volume. So you know that's going to be a big day, so you can buy. If you're a day trader, you can buy so they go up. You already hit the volume, and the stock is up. But if they hit the volume in the morning at 5 million, the stock is down, not looking good, so it'll come down more. If you look over here, you'll probably see big sells, not too many buys. And that's really all there is to it. There's a specialist behind all this with his computer, maintaining the flow of trading, and they pretty much are pretty consistent. You know, the idea is that you don't know he's there. You know, he's only there in case something goes wrong. He's a hacker or something, or if there's a 9/11 attack or something, then he'll slow it down. He'll slow down the trading. But let me erase it. I can erase this.
Oh, yeah.
Go ahead and cut it.